Today is March 12th, 2026, and Celanese Corporation stock, ticker CE, made a big move in the market. During the regular trading session today, the stock soared 14.75%, closing at $59.60 per share. That's a massive one-day gain for a large industrial and chemicals company, and it immediately caught the attention of investors and analysts. In this video, we'll break down why Celanese stock surged today, what the company does, how the stock has performed in recent years, what analysts expect going forward, how the valuation looks today, whether the stock might still be a buy, and the key risks investors should understand. Let's start with the biggest question. Why did the stock jump nearly 15% today? The surge appears to be driven by two major catalysts: geopolitical developments and analyst upgrades. First, analysts at Citigroup pointed to rising geopolitical tensions in the Middle East, particularly the risk that Iran could disrupt the Strait of Hormuz, one of the world's most important oil and chemical shipping routes. If that happens, it could significantly disrupt global chemical supply chains. When global supply tightens, prices for commodity chemicals often rise sharply. Companies that already have large production capacity can benefit from those higher prices. Celanese is one of those companies and could see higher margins if chemical supply becomes constrained globally. The second catalyst was a wave of analyst upgrades and bullish commentary released around the same time. Citigroup raised its price target to $81 from $75 while maintaining a buy rating. Tudor Pickering and Vertical Research also upgraded the stock to buy, signaling growing confidence in the company's recovery story. Meanwhile, Bank of America previously raised its target price to $70 per share. When you combine potential supply disruptions with multiple analyst upgrades in a single day, it can quickly drive strong buying momentum, which is likely what we saw today. Now, let's step back and talk about what Celanese actually does. Celanese Corporation is a global chemical and specialty materials company headquartered in Irving, Texas, and it's a long-standing member of the Fortune 500. One of its biggest businesses is the acetyl chain segment, where the company produces basic chemicals like acetic acid and vinyl acetate monomer, often called VM. These chemicals are essential ingredients used in products like paints, coatings, adhesives, and industrial solvents. Celanese is widely considered one of the world's largest producers of acetic acid, accounting for roughly 20% of global supply. Another important division is engineered materials, where the company produces high-performance specialty polymers used in industries like automotive manufacturing, electronics, medical devices, and consumer products. Celanese also produces acetate tow, a specialized fiber used to manufacture cigarette filters, which remains a steady cash-generating business. Now, let's talk about how the stock has performed historically, because the story here is mixed. Over the past year, Celanese stock has increased about 12.9%, which is a solid return. But if you zoom out further, the picture becomes more challenging. Over the past 5 years, the stock has actually fallen roughly 59.7%. Several factors contributed to that drop, including cyclical weakness in chemical demand, integration challenges after acquisitions, and concerns about the company's balance sheet. That leads to the next question: what do analysts expect for the future? For the next 12 months, the average analyst price target for Celanese currently sits around $63 to $64 per share. That's only slightly above the current price of about $59, suggesting analysts see moderate upside in the near term. However, the range of estimates is wide. The high estimate is around $81, which comes from the recent Citigroup upgrade. The lowest estimate is around $41, showing that not everyone on Wall Street is convinced the turnaround will succeed. Looking further out, some valuation models suggest higher potential. Some frameworks estimate a fair value above $100 by around 2027 if the company successfully executes its recovery strategy. Now, let's look at the current valuation of the stock. Based on analyst forecasts, Celanese trades at a forward price-to-earnings ratio of roughly 10.2 to 10.3. Its trailing P/E ratio is around 7 times earnings, depending on the data source. On the surface, those numbers suggest the stock is cheap relative to earnings, which is why some investors view it as a value opportunity. Analysts are also projecting earnings growth in the coming years, especially if demand for industrial materials improves and the company reduces debt. But the big question investors are asking is Celanese still a buy after today's rally? The answer depends on whether you believe in the turnaround story. The bullish case focuses on several points. The company generated about $773 million in free cash flow in 2025, which provides a strong foundation for paying down debt. If chemical demand improves and margins expand, earnings could recover significantly. Institutional sentiment has also improved recently, with the overall analyst consensus leaning toward outperform, with a rating around 2.3 on the typical 1 to 5 scale, where lower numbers are more bullish. However, the bearish case still exists. Some analysts remain cautious because the company took on substantial debt following its 2022 acquisition of DuPont's mobility and materials business. That acquisition expanded Celanese engineered materials segment, but it also left the company with roughly $11 billion in net debt, which remains a concern. So before buying the stock, it's important to understand the key risks. First, the high debt load is probably the biggest risk. If the global economy slows and earnings fall, the company could face pressure managing that debt. Second, the business is highly cyclical. Demand for chemicals and industrial materials often moves with the broader economy. Weakness in industries like automotive manufacturing, construction, or electronics could reduce demand. Third, there's geopolitical volatility. While current tensions may support higher chemical prices, any sudden easing of those tensions could reverse the supply shock narrative that helped drive today's rally. So overall, Celanese is a company with strong industrial capabilities and potentially attractive valuation, but it also carries significant financial and cyclical risks that investors need to weigh carefully. Today's surge shows how quickly sentiment can change when geopolitical developments and analyst upgrades align. Thank you so much for watching. If you found this analysis helpful, please like this video and subscribe to the channel for more updates on trending stocks and market analysis. And I'll see you in the next video.